Hello, and welcome to our latest portfolio update. We've been on quite a ride in 2026, and despite a torrent of political developments and almost continuous news flow, most markets are higher now than they were at the start of the year. The portfolios have successfully captured these strong returns. But now we must ask the question, where are things going from here? And how can we position to benefit from those developments going forward? There are three key themes that we expect to drive markets over the next 6 to 12 months. And it's around those trends that we are currently positioning portfolios. The first theme remains unchanged. It is navigating some risks. Markets have been choppy this year, and we have responded with agility. All in all, we remain reasonably optimistic that the global economy is on firm footing. Companies keep beating profit expectations, and government spending is supportive. That said, it's not all good news. The outlook for the US-Iran conflict remains uncertain, while the war in Ukraine continues to generate uncertainty. Bringing this all together, we retain a positive view on stocks, although not quite as positive as the last quarter. We had taken the market sell-off in March as an opportunity to buy into stocks. Since then, there has been a strong rebound, and so at the end of June, we took some profit from our holding. Additionally, we maintain several positions to steady the portfolios against geopolitics, most notably gold, given its ability to support portfolios during those periods of uncertainty. We're also cautious on the dollar, which could come under some pressure given the changeable direction of US foreign policy. The second theme is beyond artificial intelligence. The AI trade has powered markets forward over the past couple of years, and while we continue to see it as an attractive investment theme, we are starting to ask, what comes next? More specifically, what will the second order effects of that AI boom be, and how can we position portfolios to benefit from those? To this end, we see two key areas for further investment. The first being the AI supply chain, in particular hardware such as semiconductors. To that end, we are tilting towards emerging market stocks, which have significant exposure to companies deeply embedded in this ecosystem. Second, we are conscious that to support the AI build-out, a significant amount of energy infrastructure investment is likely on the horizon. As a result, we are holding exposure to listed infrastructure companies who are likely to benefit from that cycle. Finally, we closed our position in US value after it delivered strong returns. The third theme is inflation concerns. The closure of the Strait of Hormuz disrupted global supply chains, the consequences of which will last beyond its reopening. Furthermore, damage to infrastructure in the region will constrain energy supply over the medium term. Both of these factors are likely to keep upward pressure on prices and result in sticky inflation. This expectation of higher inflation is primarily influencing our view on bond markets. Most notably, we continue to have a preference for shorter dated and inflation-linked government bonds. Additionally, we've added a holding to Chinese government bonds, which have proven a good diversifier during periods of historic inflation spikes. If you'd like more detail about our outlook, portfolio changes, or performance, then check out our latest quarterly update. Thanks for watching.